Welcome back. Well, we've certainly had a week full of economic data, so I thought it might be helpful to take a step back and look at some of the various financial markets and barometers to try to gauge what's happening. We had earlier this week, Federal Reserve met. They raised interest rates by 0.75%, another 75 basis points, indicating that they will continue to raise interest rates over time. Now, it is contingent on the fact that the employment markets, that jobs do not tumble. Well, earlier today, the non-farm payrolls was released, 262,000, I believe. That's higher than the estimates of 200,000. So that certainly does give the Federal Reserve license to continue to raise interest rates over time. And we've seen this manifest in a number of different ways. Let's start off with the bond markets. These are the treasury markets. We have the 1-year bond just a hair below 4.8%, the 2-year just a little bit below that. Take a look at that compared to the 10-year bond, which is below 4.2%. We've had an inverted bond yield, the difference between the 1 and 10-year bond in excess at some point of 66 basis points. I saw it's well over 0.5% in favor or higher on the 1-year bond than the 10-year bond. And we know normally in healthy economic climates, the longer term maturity like the 10-year bond will pay a higher interest rate than the shorter term maturity. So certainly this is something to be aware of. If we take a look at the following graph, I know there's a lot going on here. Every line represents a different year going back to 1990, and it shows the total yield that's offered among all the treasury bonds. So if you take the yield of the 1-year bond and the 2-year bond all the way up to the 30-year and add it all together, we can see the total yield that's offered across the entire fixed income market. In particular, note the dark black line here. That represents this year, 2022. Notice the incredible increase in interest rates that has progressed from January through present day. We've seen a larger progression, a greater increase in interest rates this year than I think in any other year going back 30 years or so. Take a look at this graph. This shows us the absolute increase, 250% increase in the total yield across all the different maturities. And I think it's important to mention this because we say, okay, well, we have an inverted bond yield, so the short-term bond yields are going up more than long-term. But overall, all the bonds are increasing more than they ever have before, at least going back to 1990. It really is a very dramatic increase in interest rates. Now, the blue histogram bars here show the S&P 500. That's the performance going back to 1990 again. And the red line represents the bond yield performance, meaning how much have bond yields gone up or down. Now, we should take a step back and say under normal economic conditions, when the stock market is strong, the interest rates, the Federal Reserve tends to raise interest rates to cool off the economy, and the bond yields go up. So usually you see kind of a strong correlation. The blue line goes up and so does the red line. The blue line goes down and so does the red line. Notice 2008, we had a crash in stocks and major decrease in bond yields. This year is very unusual because we have about 25% decline, 30% decline in stock markets, but we have such a dramatic increase. Now, we can explain this in the sense that we have the Federal Reserve that's raising interest rates to quell inflation. The stock market at the same time is going down in anticipation of this inflation, or anticipation, I should say, of the higher interest rates, which again the Federal Reserve is trying to fight with higher interest rates. Now, the fact of the matter is, usually we see the stock market go up, yields go up, then the stock market goes down, and then yields tend to follow. The Federal Reserve seems to be behind the pace, so to speak. But this is a very unusual year, how yields are going up as stocks are going down simultaneously. This represents a tremendous diversion. The blue histogram bars in this case show the S&P 500 performance, and the yellow line, or the yellow histogram bar, shows the divergence. Again, it just shows us in a different way the difference between the stock market performance and the bond yields. Usually, you see the yellow lines are moving in the upward direction. There's a strong correlation. Stocks are up and the yields are up. Stocks are down and the yields are down. But this is a tremendous, tremendous diversion from that, and it's something I think that's very unusual. Now, moving to the present day yields. The blue line represents the S&P 500, and the red line represents the 10-year yield, and the 1-year bond, or the green line represents the 1-year yield. And we can see that this is such a dramatic inversion. The green line is always above, or has been since July, above the red line, the 10-year. The 1 is above the 10. And that shows us that there's no contraction. In fact, it's actually even wider than we've seen before. I think this is the widest spread we've seen this entire time. So that certainly is something that's very dramatic. And again, not every inverted bond market forecasts a recession, but every recession has been predated by an inverted bond yield. So it's certainly something that's very important to take into consideration. Take a look here. The blue line, yes, is the 1-year bond yield. The green line is the 2-year. The 1 is above the 2. The black line is a 10-year bond. And we can see there's an inversion. Not only are the short-term bonds above the black line, but also the 1-year bond yield, the jagged blue line, is above the green line. That's also a minor inversion, or an inversion on a minor level, meaning that it's not only the case where the short-term bond yields are above the long-term, but the shortest-term bond, well, not the shortest, but the 1-year is above the 2-year. That just shows us how extended this inversion is on the bond markets. Take a look at the following chart. Every line represents a different month of the year. So starting at the bottom, that represents January. Now, what this shows us is the bond yield curve. The 1-month bond paid a very small interest rate, almost zero, and the 30-year bond paid a much higher. Notice the blue line is sloping very, very consistently to the upside. The same holds true for the orange line and the red line. That's February and March. All of a sudden, April, we see this curve. That's really when the inverted bond market started to show its head, where we have the 3-year yield that's just a little bit above the 10-year. Not a big deal. Then we have the purple bars in May. The green is June. The blue line is July. August is really where the inversion took a different turn, or an extended turn, where we have the 1-year yield. Take a look at how the 1-year yield all of a sudden pops up in August. September, we see a continuation. October, and now the current month, November. This is just for the past couple days. Take a look at how dramatic the 1-year bond yield is much, much higher than the 10. Really a tremendous, tremendous inversion. Now, this is not the only market we can take a look at. The blue line is the S&P 500. This is a historical chart. It's not current. The red line shows us the VIX, the volatility index. The volatility index measures the price, the premium on the options, the short-term options on the S&P 500. It's also known as the fear gauge. The VIX goes up usually when stocks go down. Traders tend to buy options to hedge, stocks, or sell covered calls to hedge in case, the stock market does go down. So this is a relationship. Stocks go down and the VIX goes up. Well, currently the VIX is at a level right around 25, and we can see what this means for us. This is the level 25 right here, and we can see that the forward-looking performance of, let's say, the 90-day performance on the S&P 500 when the VIX is 25 is around 10%. When the VIX is low, it means stocks are strong. And if stocks are strong, it means, well, maybe stocks aren't going to be so strong in the future. But if the VIX goes up to 40, for example, then generally speaking, it's thought that the stock market will then go to the upside, because the VIX goes up after the stock market has crashed, or simultaneously while the stock market's crashed. Now, it's also important to take into consideration the seasonal factors. There are certain months of the year historically that stocks are very, very weak. October is one of them, sometimes November as well. So take a look at the VIX with a 25 VIX in the month of November, we statistically have in the next 90 days, a forward-looking 90 days, we can make as much as 11%. This is not the average. This is the max amount of money we could have made buying the stock market when the VIX is at 25 in the month of November. Now, if we see the VIX climb up to the 35 level, then our performance, our expected performance, then tends to increase. And the same numbers to some extent also exist in December as well. But really, November shows us potential superior performance if the VIX remains around the 25 level. If the VIX goes higher, well, that means stocks are going to go down if the VIX is going to go higher. But conversely, if that happens, then we could expect superior performance from that. Now we can see here, over the next 90 days, the VIX shows us the maximum, on average, a maximum performance that we can expect from the S&P 500, not so good. Again, if the VIX goes up to 40, this is the average over across all time frames, all months, I should say. But if the VIX goes up to 40, then we can expect superior market performance. But again, if the VIX goes to 40, it means stocks will have gone down a lot. If the VIX stays at 25 or lower, that's, I would say, a risk-off situation, meaning that the more the stock market goes up, the more risky it is. Take a look here. We can see there's actually very little data with a VIX at the 25 level in the month of November. But again, the performances are inferior. We usually do not expect to see great stock market performances in the month of November when the VIX is already down. If we looked at the VIX today and it was at the 40 or 45 level, I think we'd be like a lot more optimistic as a result. And lastly, I also want to take a look at the gold-silver ratio. The gold-silver ratio is very simply the price of gold, in this example, $1,800 an ounce, divided by the price of silver, which is $25 an ounce. You divide 1,800 by 25, and in this case, it gives us a level of 72. There's 1 ounce of gold equals 72 ounces of silver. Now, the average historically is around 55. Gold has a better relative value when the gold-silver ratio is below 50. Silver is a better buy when the ratio is above 60. Well, we can see right now, well, this is a historical chart. The black line here is the gold-silver ratio. And we can see, generally speaking, as the gold-silver ratio goes up again, this means that gold is outperforming, or the gold-silver ratio goes up, means gold is outperforming silver. Now take a look at 2019-2020, the most recent, very significant stock market crash. Silver plummeted. Silver is a more speculative metal. It tends to go up when stocks are doing well, when traders are investing, or investors are placing their money in high-tech companies that use a lot of silver for their components. Gold is more of a more pure economic hedge. When the dollar goes down, gold goes up. So take a look at the gold-silver ratio, which is the purple line, and the price of gold, which is this yellow line. Generally speaking, we can see that when the gold-silver ratio goes down, so does the price of gold. Again, it's the price of gold divided by the price of silver. So generally speaking, there's a positive correlation. However, right now, the gold-silver ratio, I would say, is probably a little bit distorted in the sense that gold has gone up recently and the gold-silver ratio has gone down. But actually, we'll see in just a moment, that's not the case. Take a look at here, the high blue histogram bars, that's a 90-day performance. We also have the shorter term performances. The gold-silver ratio right now is around 80. We can expect, this is the forward-looking gold performance. We can expect inferior gold performances when we see the gold-silver ratio below the 80-85 level. Okay? Now, if the gold-silver ratio goes up, then we may see a different situation. Take a look at the price of silver, which has really gone up a lot. That's the white line, and the gold-silver ratio has gone down. Now, again, going back to 2019, 2020, silver plummeted, and the gold-silver ratio went up a lot. Compare the white line here. That's the price of silver So here, the price of gold. Notice the difference? This yellow line is closer to the bottom of its range compared to the white line near the upper end of the range. This is silver, almost ready to break new highs. This is gold, near a double or even triple bottom. Again, here's silver. So this is telling us that silver is outperforming gold. And again, silver tends to move in the same direction as stocks. When stocks go up, traders are more optimistic and they tend to buy silver over gold. Take a look at this is the gold-silver ratio and the price of silver, and the performance, I should say, of silver. And again, the performance of silver tends to do better when we see a gold-silver ratio above 85, 90 or so. We saw a dramatic increase in the gold-silver ratio, again, 2019, 2020, and that's when you could have bought silver very cheaply, and it tended to do very well after the fact. And as well, take a look at the blue line. That's a gold-silver ratio, and the S&P 500. That's the red line. As the S&P 500 goes down, the gold-silver ratio goes down. We're seeing a little bit of a divergence here, and I think overall what's happening is as follows. The Federal Reserve has pledged to continue to raise interest rates. Today's better than expected non-farm payrolls gives the Federal Reserve more ability to raise interest rates over time. So as a result, the dollar's going up and bond yields are going up. When the dollar goes up, gold and silver go down. But we're noticing again, silver's outperforming gold. Gold is going down a lot because the dollar's going up. Well, is silver going down because the dollar's going up? Yes, but to a lesser extent. So silver outperforming gold, the dollar outperforming other currencies, and for the time being, we've seen a little bit of a bounce. Relatively speaking, we've seen a little bit of a bounce in the S&P 500. If this turns, if stocks go down, that won't necessarily mean that gold and silver are going to reverse. It just means that stocks are going down in anticipation of higher interest rates, and that could be led to better non-farm payrolls in the future. It could also be the results of better than expected or higher than expected inflation numbers. We have a lot of CPI, PPI, and PCE inflation numbers coming in the near future, so they'll certainly be very interesting to see. We hope this has been helpful. We look forward to seeing you back soon.